How is an estate taxed? As previously noted, upon the death of an individual, their estate is deemed to have acquired all their assets at the fair market value at the time of death. The executor must then deal with these assets as described in the will. In some cases, it may take significant time to deal with these assets, or the deceased may wish the executor to hold these assets for a period of time. For example, in the case where a parent dies and leaves assets to a minor child or a child that is incapable of handling their financial assets. During the time the executor holds these assets, there may be additional taxes payable as these assets may continue to increase in value or generate income. The executor is required to file additional tax returns to account for these assets held during their time of administration. Recent changes by the government have significantly increased the complexity in dealing with taxes at an estate level. The new legislation introduces the concept of a graduated rate estate, or a GRE. A GRE is taxable at a preferential rate versus non-GREs. However, only one GRE can be created on the death of an individual. In addition, the preferential rate will only be available for up to 36 months post the date of death of the individual. When an individual leaves their assets to a spousal trust rather than to their spouse directly, there is no tax at the time of the first person's death. However, upon the death of the second spouse, taxes on any accrued gain to that time will be taxed in the trust.